What's good, everybody? Welcome to Chat with Jat. This is episode 11. It's the 7th of September 2022. Today's video is going to be all about the Bank of Canada's rate hike. Today, the bank announced that they're increasing their benchmark rate by 0.75%. So what this means is now their total benchmark rate is 3.25%. That is the guidance. That is the floor for banks to borrow from each other overnight, 3.25%. That's the rate in Canada now. Now, what does this mean for mortgage holders? So let's get the first thing out of this is the fixed mortgage holders. You don't have to worry. Your rates are going to stay the same. The only time you're going to have to be stressing is if your mortgage is coming up for renewal. So if your mortgage is coming up for renewal in a few months, in a year, 2-3 years, you need to start planning for higher payments, especially if you're barely getting by with your current payment today. You should anticipate a bigger payment, which means you need to plan. You need to get a new job. You need to get a second job. You need to get people at home working. You need to get roommates. You need to cut down your costs. You need to come up with a solution to make those extra payments, especially if you're one of those guys who locked down a rate at 1-2%, and now you're potentially going to have to renew at 5-6%. This is something you need to plan for. Now, variable mortgage holders, I feel your pain. I'm in the same boat with you. You are the ones who are really in the heat, in the thick of it. And there are three things to think about. First, if you're running with the variable open, I believe it's called open, where your payment terms are a function of the interest rates, because no matter what, you told the bank, I want to pay down my mortgage in 25 years. So if rates go up, increase my payments, then you are in the thick of it, because obviously rates have been going up back to back and you have been eating those increases with increased monthly payments. And the plus side of this is that obviously you're going to pay down your mortgage within a fixed period of time. The negative side is you can't plan for your cash flow. You can't manage cash flow, and you always need to have a buffer, an emergency plan. If rates keep going up, you need to be able to eat those increased payments, because if you suddenly become insolvent and you rush to put your property on the market, you're probably not the only person doing it, and you're not going to get the best price for your home or investment property. Now, everybody else who's rolling with a variable close, so people's rates are fixed, but your interest is going to be fluctuating and your principal is going to be fluctuating, you're okay until you're not. So what that means is once you cross that trigger rate, once you cross the point, that critical point where your payments don't cover the interest anymore, then the bank is going to say, okay, you have to fold your cards. We're going to have to revisit how much you're paying, and you're going to be paying X, whatever you're paying in the past, plus Y, an extra $500, $600, $700 to sufficiently cover your mortgage interest and pay down your principal. So I assume a lot of people are slowly approaching this trigger rate. There are options. You can make a lump sum payment to keep your payments the same. You can try looking at making frequent payments, so weekly payments, to reduce the interest that's being charged on your balance, because you're paying weekly now instead of once a month. So that could potentially alleviate how much extra you have to pay. And there are some banks who would be open to negotiating your terms and saying, okay, well, instead of saying spread it over 25, let's spread it over 30. So your payments are less to pay down your principal, and you can stomach the interest payments, and your current payment would be enough. So depends on your deal, depends on your bank, depends on how open they are. Obviously, banks, they're in the business of making money. So if they can keep you going, and they're smart, they're not going to try to force people to rush into market and sell their properties, because that means banks lose overall. If they're smart, they're going to negotiate with you. They're going to say, okay, let's see what we can do to respect your wishes, and make it all work. So that is something that you need to be mindful of. Now, what am I going through? So I have two rental properties that are rolling at variable mortgages. I realize in hindsight, I should have just locked it down at fixed. I actually renewed my mortgages during COVID, so I had an opportunity to get a very good fixed rate, but I didn't do it because the variable rates were nominally better. And my feeling was, we're in the thick of a recession, we're in a COVID pandemic. There's no way that the banks are going to move to kill the economy by raising rates. So I felt relatively comfortable because before the pandemic, the rates were already relatively low, and there was no pandemic. So it made no sense to me for them to suddenly ramp up the rates. The logic made sense. The logic checked out. What I didn't anticipate was massive worldwide issues that impacted Canadians. So the price of oil is suddenly so much higher because there are sanctions on Iran, there are sanctions on Russia, so their oil is not on the market, which is keeping prices high, which is making the prices of everything high, from oil being an input in a manufacturing process to oil being a transport energy, a fuel source, to things being expensive to ship, to finally things getting to your door. So obviously the cost of everything is going up because of that. And then I didn't anticipate Russia to go try to conquer Ukraine, and that's going to shoot the price of grain, shoot the price of food up in the worldwide markets. And it's gotten to the point that even India is withholding their rice from international markets so that they can feed their own people. So this is what's happening today. The prices of everything is going up because of global issues, and we Canadians are in for the ride because we're not able to sustain ourselves in a closed off environment. We import a lot of stuff. We might export oil, but we don't set the worldwide oil prices, and then we import the refined fuel. So we're at the mercy of global markets. So what the Bank of Canada right now is trying to do is they're just trying to raise the rates as high as possible within a reasonable limit to kill demand. They want to kill demand in Canada, and they're hoping that by killing demand in Canada, prices will start to taper off and come to reasonable levels. And the truth is, there are certain areas that they need to start killing demand because speculation is rampant, and that's one of the main ones are housing. Housing has been really, really expensive for certain markets, and it's because there's a lot of people speculating with cheap money, or people who have access to cheap money through their equity or whatnot. So these markets need to be brought under control so that people can live and afford a home, but also at the same time you find that right balance, because I really do believe an efficient market needs investors, needs builders, needs people to have incentive to build more new homes, nice homes, homes that are in demand, so that people can continue to thrive and they don't have to live in old ghetto homes. So having said all of this, what I think is going to happen now is the bank is going to continue its march forward. Their policy rate is 3.25%, which means the banks are going to be borrowing from each other at 3.25%. The banks have the option to pass this increase on to their consumers, but banks do not have to pass it on to the consumers, but they can. At a certain point, they're going to try to be competitive versus the other, and this is where businesses kick in. Businesses are going to say, okay, well, my borrowing rate is at 3.25%, but instead of giving you a fixed rate at 6, I'm going to give you a fixed rate at 5, so I can maintain my spread of 1.75 instead of trying to have 2.75. Like, it's going to happen. Right now, everyone's acting together in sync and raising the rates, but banks are going to start showing their cards, and some banks are going to be more aggressive than others, trying to scoop up mortgages at lower rates versus other banks. So I would still, be open to see what's out there in the market. Don't really rush into something fixed if you're not pressed and if you're able to stomach the uncertainty and the increases. Now, what I personally did in the beginning of March was when they first announced their first increase, I said, okay, let's do a worst case scenario to see where things are going to go. And today, we're pretty much at my worst case scenario. And at that time, I had the option of getting a fixed mortgage at 3% at 5 years basis, or 2% on a 3-year or 2-year basis. But I didn't. I just said, let's write it at variable. Let's see where it goes. So I'm just going to update that right now, and let's update it together, and we'll see where things are going. So right now, you know, the best rates on the market are hovering around 5 to 5.515% for the big banks. So if they're all going to increase by 0.75, they're going to be in the high 5s or 6s. And I've heard that some people started getting calls from banks trying to incentivize them to increase or to switch to a fixed mortgage at a 5% rate, because banks know that the rates are not going to be at this high for a long time. So my feeling is that banks are trying to strategize by getting more people to convert from variable to fixed so that they can make more money off of these people. And when the Bank of Canada tapers their rates and say, okay, it finally hit where we need to go, inflation is at 2-3%, we're going to start lowering the rates a little bit, then the banks are going to be laughing. But we don't know how soon that's going to happen. So let's see what I have done as a scenario. So in this scenario here, this is my worst case scenario. I said that we're in Q1, we're going to be at, my rate was 1.7. So I said at Q1, we're going to be at 1.7. And then during Q2, so during April, May, June, the Bank of Canada did raise the rates, and I was rolling at 4%. So this happened. And now the Bank of Canada is raising the rates to 4.75 as of September. So in August and in July, I wrote it out at 4. So let's say we do this: 4%, 4%, 4.75%. All right, assuming that the months are equal, this is the rate, my average rate in Q3. And then for November, October, November, December, I'm going to be at 4.75. All right, great. Now, assume in the beginning of 2023, they increase another 0.5, and then there's nothing, no increases. But maybe let's do a worst case scenario. They increase it again, 0.5, okay? They increase it again in Q2, 0.75. I mean, 0.5%. So, oops. Now I'm at 5.75. That 5.75 stays the same. No more increases. Then they increase it again to 6.25. Then they decrease it. At the end of the day, my average rate would be 4.6. If this plays out, then I'm going to be at 4.6. So today, the best mortgage rates are hovering around the low 5s, the high 4s to low 5s. And that's if I sign a deal today, which is not going to happen. Tomorrow, it's going to go from the mid 5s, so 5.5 to 6%. So why would I commit to switching to 5.5 or 6% for the remainder of the term, which is for all these periods, when my average is at 4.6 if I just write it out? Like, why would I commit to that? It makes absolutely no sense. So that's my logic right now. I'm going to write it out. I'm going to see where it goes. I'm not too stressed. And I recommend that everybody who is on a variable mortgage, educate yourself, figure out how much of your payments are going to interest, how much of your payments are going to principal, figure out what your critical rate is, where your trigger rate is going to happen. If your trigger rate hits X, then suddenly your payments are going to go up. Make sure you know what they are. Look into your options with your bank. See if you can increase your payment frequency so that you're not paying interest once a month on a big balance. Like what I'm trying to say is, imagine you have a $100,000 mortgage. If for the entire month you have a $100,000 mortgage, and then at the beginning of the next month you're paying interest on that balance, obviously it's a interest rate slapping it on the 100K. So let's say for simplicity, interest rate is 10%. 10% on 100K is 10 grand. So you're gonna have 10 grand interest. But if you're chipping away at that 100K every week at, you know, $1,000 a week or something, then suddenly you're paying interest on 99K for 1 week, 98K for week 2, 97K for week 3, and then 96K for week 4. So overall, your interest is a bit lower than being the full 10K. So you will save some money here and there by doing that. So consider these options. And I really do think making lump sum payments are not going to change much. It's better to have cash. If you have cash on the side, hold on to it. Don't do lump sum payments because we don't know where the world is going. It is very possible that the rates can go up to 10%, 20%, 30%. Nobody knows, okay? Nobody knows. But what I could say is always have cash for a rainy day and write it out. I'm going to write it out. I'm going to see what happens. I'm okay with the ambiguity and the uncertainty, but write it out. If you're doing this on your own, if you don't have any partners or investors, or if you don't have very good income, then, you know, I would consider switching to a fixed and removing the ambiguity. But if you are able to tolerate it, write it out, see where it's going to go. And I really think, and I'm really hoping that inflation does get under control and the Bank of Canada will start slowing down their aggressive increases and they would start tapering off. So this is my video as of 7th of September. Let's see what happens. Nobody knows what's going to happen. So it really comes down to your fit, your personality, what you can tolerate. Think about that, do some soul searching, and then make a decision. All right. I'll see you later. If you like what you heard, definitely hit the subscribe button. And if you have any questions, leave them in the comments. I'll do another video and I'll stay in touch. All right, see you later.